Money feels solid, like something you can hold, spend, or save. But beneath the coins and bills and balances, there's a deeper truth. Every dollar begins its life as a promise. Not gold, not productivity, but debt. Created when someone borrows, erased when someone repays. The U.S. economy, from household loans to corporate bonds to government spending, is built not just on money, but on the act of owing. Welcome to Series 4, where we follow the architecture of the debt machine.
Let's start with something that feels, well, really fundamental, but is actually misunderstood. We tend to picture money coming off, government printing presses, right? Big stacks of cash. But what if we told you that's not really how most money, the money in our modern economy, actually gets created?
Yeah, that image, the printing press one, it definitely covers physical currency, notes, and coins, but it misses the main event, really. The core mechanism for the digital dollars that make up almost everything.
Which brings us to this provocative idea we're diving into today. It sounds a bit counterintuitive, maybe. The idea that all dollars are born from debt. Sounds strange, maybe even a little unsettling, but getting your head around this is just critical to understanding our financial world.
And when we say born from debt, what we mean is that, well, virtually every dollar, the numbers you see in your bank account, even the cash in your pocket, it starts its life as someone's liability, an IOU. It's brought into existence through borrowing, whether that's you getting a mortgage or a business taking out a loan or the government issuing bonds. Your money fundamentally represents someone else's debt.
We've got the stack of fascinating sources you shared covering, well, everything from old economic thinking and central bank papers to current debt stats and competing theories. We're going to try and trace where this idea came from, see how it actually became the reality of our system, map out the huge landscape of different kinds of debt in the U.S. economy, see how they're all tangled up, and crucially, understand what this basic truth about money means for you.
Yeah, and we have a lot to draw on. Historical thinkers, how central banking evolved, detailed data on U.S. debt, and the ongoing debates about what money even is.
All right, let's pull back the curtain then. Explore how this foundational concept really shapes the economy we all navigate every day.
So this idea that money and debt are fundamentally linked, it's actually not new. Been debated for centuries, really, but it started getting more traction in economics, maybe early 20th century. You had thinkers like Alfred Mitchell Innes writing way back in 1913. He argued against the old idea that money just evolved from barter. He proposed something called the credit theory of money. He saw money not as some valuable thing like gold, but as a credit, an IOU, basically a social obligation, a debt acknowledged by the community. And he thought this existed long before coins.
So less a physical thing, more like a system for tracking who owes what, like a network of promises.
It's a social technology, really, for managing obligations. And this insight started to influence mainstream economists as they looked at the modern banking system. John Maynard Keynes, for instance, writing in 1930, he saw very clearly how banks were creating money when they made loans. He wrote that all deposits are created by the bank holding them when they lend, not just moved from cash someone deposited.
Wait, hang on. So banks aren't just intermediaries, taking money from my savings and lending it to someone else.
Well, that's the common picture, but it's a misconception. They do facilitate moving existing money, sure. But the act of making a new loan, that's where most new money creation actually happens. When a bank approves your loan, they just credit your account with new funds. Poof! They simultaneously create a loan asset for themselves and a deposit liability. And that deposit is new money entering the system. It makes the money supply largely endogenous, meaning it's generated inside the economy by banks meeting demand for credit, not just dropped in from outside by, say, the government.
And even economists you might think of as, well, opponents of Keynes, Milton Friedman, for example. Did they see this bank-driven process too?
Oh, Friedman and Anna Schwartz's big book, A Monetary History of the United States. It meticulously documented how the expansion and contraction of bank credit was fundamental. It drove the money supply, economic cycles. They argued it was central to the Great Depression. Now, Friedman focused on controlling this process, but his work highlighted the power of fractional reserve banking, how it multiplies central bank money into a much bigger pool of bank-created credit money. He even explored ideas like 100% reserve banking early on, precisely because he saw the potential instability in letting private banks create money through debt.
So across different economic schools, there was this growing realization that most money circulating was a direct result of debt being created through lending.
Yes, and then post-Keynesian economists later really built on this. They solidified the loans create deposits understanding in the, say, late 20th century. People like Hyman Minsky. He emphasized how money comes into being when loans are made, and it disappears when those debts are paid back. He linked the money supply directly to credit cycles and, importantly, financial stability. Minsky put it pretty starkly. Money is unique in that it is created in the financing activity of a bank and disappears when the debt is fulfilled.
Which, if you really think about it, paints a different picture of the economy, doesn't it? Where financial stability isn't just about, balancing budgets, but managing the actual creation and destruction of money tied up in these debts.
Precisely. By the late 20th century, the understanding was pretty solid. Most modern money originates as a liability, either a bank's liability, like deposits, or a government's liability, like currency or bonds. And it's brought into existence through credit. And that this understanding was really key to how central banking evolved and sort of formalized this whole system.
Speaking of formalizing it, the origins of central banking itself seem, deeply tied to this debt idea.
Oh, they are. Take the Bank of England, founded way back in 1694. It was created explicitly to lend money to the government, to finance a war, actually. The bank issued notes, basically its promises to pay gold, and in exchange, it got interest-bearing government debt, government IOUs. So this model, where a private bank's money, its notes or deposits, was backed by public debt, that was an early blueprint. And fractional reserve banking then grew out of this as goldsmiths and later banks realized they could issue more notes or credits than they actually held in gold or cash reserves, because not everyone demanded their gold back at once.
So they were essentially taking in one kind of IOU, the borrowers promised to pay them back, and issuing their own IOUs, notes, or deposit credits that functioned as money.
As you see in historical accounts, banks started creating money just by crediting borrowers' accounts or issuing banknotes against loan agreements, far exceeding their physical reserves. Each loan generated a new deposit or banknote new money mirrored by the borrower's obligation to repay. It's the core of modern banking. Lending creates new deposits.
And it's not like central bankers were unaware of this or trying to hide it. Some were open about it, weren't they?
Incredibly candid. Mariner Eccles, who was Fed chairman during the Depression and World War II, he testified to Congress in 1941 about how the Fed created money to buy government bonds. He just flat out said, "We created it out of the right to issue credit." And when someone pressed him, "What's backing it?" He said, "That is what our money system is. If there were no debts in our money system, there wouldn't be any money."
Wow, that's pretty direct. If there were no debts, there wouldn't be any money.
And Robert Hemphill, a credit manager at the Atlanta Fed, wrote in a preface to a book in 1936. He said if all bank loans were repaid, not a dollar of coin or currency would be in circulation. He stressed, someone has to borrow every dollar we have in circulation, cash or credit. These officials knew the entire money supply depended on ongoing debt issuance.
And didn't the Chicago Fed put out that famous booklet, Modern Money Mechanics, explaining the money multiplier? Though I hear that model's a bit outdated now.
Yeah, that booklet described how reserves could let deposits be multiplied through lending. But you're right, modern central banks, like the Bank of England in that landmark 2014 bulletin they published, they explicitly clarify that the old money multiplier model is, misleading. Banks don't passively lend out reserves they already have. They create new deposits whenever they decide to make a loan. The Bank of England was totally unequivocal. The majority of money in the modern economy is created by commercial banks making loans.
Yeah. They don't just facilitate lending, they literally increase the money supply by lending. So the whole institutional framework, central banks plus commercial banks, really solidified this reality. Every new dollar gets into the system primarily either as a commercial bank loan, which is private debt, or through central bank actions or government deficit spending, which relates to public debt.
And just as money is created through debt, it's also destroyed when debts are repaid. And this link, this inherent connection, became even clearer, even more amplified when we moved away from money backed by commodities like gold.
The gold standard era kind of masked this, didn't it?
To some degree, yes. Under a gold standard, banknotes and deposits were, in theory, convertible into gold. So while banks were still creating money via loans, they were somewhat constrained by the risk of running out of gold if they lent too much. But financial crises still happened, precisely when credit booms created claims that far exceeded the available gold. That revealed the real backing was always the promise to pay the debt obligation, not really the gold itself.
Then after World War II, we had Bretton Woods. The dollar was pegged to gold, other currencies pegged to the dollar.
Yeah, a sort of quasi-gold standard. Domestically, money was still mostly bank deposits from loans. But international trade and finance relied on this dollar-gold link. The problem was the U.S. ran bigger and bigger deficits, expanded dollar liabilities all over the world. Eventually, the gold peg just became unsustainable. And in August 1971, President Nixon ended the dollar's convertibility to gold, the Nixon shock.
And that was it, the point of no return into the pure fiat money era we're in now.
Correct. Currencies were no longer redeemable for any physical commodity. Their value became based purely on, well, government decree, fiat, and public trust. Trust that the currency will be accepted for transactions and, critically, for paying debts, especially taxes. This removed the last formal link to a physical commodity and really amplified the debt-based nature of money. Central banks could now expand the monetary base, maybe by buying government debt without worrying about gold reserves, and commercial banks could lend based primarily on things like capital requirements and market demand, not physical reserves.
And didn't credit and money supply growth really take off after 1971?
The fiat era made it crystal clear. Money's value is basically a shared belief. It's backed by the authority of the issuer, the state, and the institutions it delegates power to, like banks, and its general acceptability for settling obligations. Every new dollar originates either because a bank extends credit or the government spends more than it taxes, financing that gap by issuing debt.
So even the physical dollar bills in my wallet are a form of debt.
In a fiat system, yes, fundamentally.
Yeah.
Federal Reserve notes Eurodollar bills are technically liabilities of the Federal Reserve. When the Fed issues cash, it usually does so in exchange for acquiring an asset. Very often that asset is a government bond. The bond is the government's debt, its IOU, which acts as the asset backing the central bank's liability to the cash you hold. So, fiat money isn't backed by gold, it's ultimately backed by debt instruments, both public and private, and the government's power to tax.
The shift to fiat didn't invent the debt money link, but it definitely stripped away that sort of gold veneer and made the whole system more explicit, made more powerful.
Precisely. And this reality, this debt-based system, has led to very different interpretations and policy ideas from various economic schools of thought.
Right, let's get into some of those differing views. Modern monetary theory, MMT, seems to really lean into this idea that money is born from debt, doesn't it?
It does. MMT, which you associate with economists like Stephanie Kelton, starts from what's called a chartalist view. That money is fundamentally a creation of the state, a public monopoly, issued as an IOU or a debt of the state. For a sovereign government like the U.S., one that issues its own currency, MMT sees the government's liabilities, its debt, or the reserves it creates as the private sector's financial assets. That's their money.
So from an MMT perspective, government debt isn't really a problem in the way we usually think about household debt. For a country that issues its own currency, I mean.
Not in the same way, no. MMT argues the government can always create more of its own IOUs, more dollars, to pay any obligations denominated in dollars. Government deficits, financed by issuing bonds. They see that as simply adding net financial assets to the private sector. The fact that dollars are born from government debt, from their view, is actually a feature. It allows the government flexibility to finance public goals. The constraint isn't running out of dollars. It's the real resources available in the economy and the risk of inflation if spending outpaces those resources. They explicitly push back against monetary reformers who talk about debt-free money, arguing that money is inherently a debtor-creditor relationship.
And MMT proponents often point to historical or anthropological work suggesting credit systems and state IOUs actually came before commodity money, like gold coins.
Yes, reinforcing that idea that money is primarily a social and legal construct, rooted in obligation, often enforced by state power.
Okay, so that's one end. What about the other end of the spectrum? The Austrian school, they seem to see this debt-born nature of money as a huge flaw.
They are deeply critical of fractional reserve banking and fiat money, precisely because it allows money creation through credit expansion. Austrian economists, Ludwig von Mises, Friedrich Hayek, they argued that creating new money through lending introduces artificial credit. This distorts prices, it encourages investments that only look profitable because interest rates are artificially low, and it inevitably leads to booms and busts. That's core to their business cycle theory.
Didn't Murray Rothbard famously call fractional reserve banking legalized counterfeiting?
He did. He viewed creating new money that wasn't backed by physical assets as just illegitimate dilution of the money supply. From an Austrian perspective, the ability of banks to create money out of thin air through loans, helped along by central bank policy, messes up saving and investment signals. They think it unfairly benefits those who get the new money first and see it as inherently inflationary and unstable.
Which is why many Austrians advocate for going back to a gold standard, or maybe mandating 100% reserve banking.
The goal there is to stop private banks from creating money and anchor the money supply to something tangible, something outside the control of the state or the banks. Basically, eliminate credit expansion as the source of new money. This view often resonates with people skeptical of central banks, the Fed type movements. So while MMT and the Austrians both recognize that money originates as debt in our current system, one sees it as a powerful tool to be managed, the other sees it as an inherent instability that needs to be fixed.
And there are other monetary reform ideas too, aren't there? Like variations of that old Chicago plan from the 1930s?
Yes, economists like Henry Simons and Irving Fisher back then proposed mandatory 100% bank reserves. The idea was to completely separate money creation from private bank lending. Under that kind of plan, only the government would create money, maybe issuing it directly. The aim was debt-free government money, breaking the link to bank loans and interest-bearing debt. You see groups like Positive Money today echoing some of these calls, arguing the state should issue money directly for public spending rather than relying on borrowing or bank credit creation.
They question why the money supply should primarily expand only when people or businesses decide to take on more debt.
Right. They advocate for state-issued currency, or maybe even a central bank digital currency, as the main medium of exchange, with lending being a totally separate activity using only existing money. Now, critics point out that even state money is arguably a form of debt, a claim against the state's resources or future taxes. But these movements definitely reflect a desire to sever that link between private credit creation and the public money supply.
So it seems like across the spectrum, these different schools, despite having wildly different conclusions, they all fundamentally agree on the basic reality we started with. In our current system, money creation and debt accumulation are just, inextricably linked.
Which brings us neatly to the practical reality, how this actually operates in the U.S. economy today, focusing on those two main engines of money creation through debt, government deficits, and commercial bank lending.
Let's look at the government side first. The U.S. Treasury finances spending, especially deficits, by issuing debt, right? Treasury bonds and bills.
That's right. When the government spends more than it takes in through taxes the deficit, it borrows the difference.
Right.
It does this by selling Treasury securities. T-bills, notes, bonds, these are basically IOUs, promises to pay back the principal plus interest. And these are bought by, a whole range of investors. Big banks called primary dealers, asset managers, individuals, foreign governments, foreign central banks, and sometimes the Federal Reserve buys them in the secondary market.
So the Treasury issues this debt to get money, and then it spends that money into the economy.
When investors buy these bonds, money moves from their bank accounts to the Treasury's account, which is held at the Federal Reserve. That might temporarily reduce deposits in the private sector. But the crucial step is when the Treasury spends those funds, paying salaries, paying contractors, sending out benefit checks. That money flows out of the Treasury's account at the Fed and into the bank accounts of individuals and businesses in the private sector. That's where new deposits, new money from government spending show up in the economy.
So the money creation really happens when the government spends the borrowed funds, not just when the bonds are sold.
Precisely. New Treasury debt held by the public means the private sector holds new assets, the bonds themselves, and receives new deposits from the government spending. And of course, when the Federal Reserve buys Treasury bonds from the market, like during quantitative easing, QE, that's a very direct creation of new money by the central bank itself. The Fed creates bank reserves out of thin air to pay for the bonds, and the entity that sold the bond ends up with new deposits in their bank account. That directly increases the money supply.
Like all that stimulus spending during the pandemic, financed by massive bond issuance, and the Fed bought up a lot of those bonds.
A perfect and very large-scale example of government debt issuance and central bank actions directly injecting new money into the system. But while Treasury deficits are a source, the largest source of money creation in the modern economy is still commercial banks making loans.
This is the core mechanism we touched on earlier. Banks creating money when they lend. Loans create deposits.
Yes, that's the key mechanism. When you or a business takes out a loan, say a $10,000 car loan, the bank doesn't typically transfer $10,000 from someone else's savings account. They simply credit your account with $10,000. On their balance sheet, they create a $10,000 asset that's your loan obligation to them. And they simultaneously create a $10,000 liability that's your new deposit. And that deposit is new money. It wasn't there before the loan was made. This is how most of the money in checking and savings accounts we use every day actually comes into existence.
And the old textbook idea that reserve requirements tightly constrain how much banks can lend. It's not really the main limit anymore, is it? Especially since they were set to zero for most US banks.
Not the primary constraint, no. Not in the way the old money multiplier story worked. Banks are now more constrained by things like capital requirements. How much of their own equity cushion they need relative to their loans, their own assessment of profitability, and importantly, finding credit-worthy borrowers who actually want to borrow money. With reserve requirements at zero since March 2020 for most banks in the US, they don't need to have the reserves first to make a loan. They can make the loan and then find the reserves afterwards if needed, often borrowing them from other banks or directly from the Fed. That Bank of England statement from 2014 really reflects this modern reality. Banks create new deposits when they lend.
So, summing that part up, money enters the economy mainly in two ways, either through government deficit spending financed by issuing debt, or, much more significantly in terms of volume, through commercial banks making loans, which are also debt. Every dollar really starts as someone's IOU.
It's the fundamental building block. So now maybe we should zoom out and look at the sheer scale of all this debt across the three big sectors in the US economy: corporations, the government, and individuals or households. And crucially, how they're all intricately linked together.
It sounds like debt isn't just, a side effect of our economy, but actually essential to how it functions.
Oh, it's indispensable to modern capitalism as we know it. I mean, debt facilitates investment, it funds government services, it enables consumption, provides liquidity. The US economy runs on a massive amount of leverage. And the scale of it and how interconnected it is across these sectors through the financial system, well, that creates both the engine for growth and some significant potential vulnerabilities.
Let's start with corporate debt. What does that picture look like?
Right? Corporate debt is basically money borrowed by businesses. Could be small firms, could be giant corporations. They borrow typically to fund operations, invest in new factories or equipment, maybe buy other companies, or just manage their day-to-day cash flow. And it comes in lots of forms. They might issue corporate bonds to investors, they might take out loans directly from banks, or for riskier companies, they might take on what are called leveraged loans. And those also get packaged up into complex securities, things like collateralized loan obligations or CLOs, basically bundles of corporate loans sliced up and sold to different investors.
And businesses often have an incentive to borrow rather than, say, issue more stock to raise money.
Yes, a big incentive, often because of taxes. Interest payments on debt are usually tax deductible for corporations. That makes borrowing cheaper than issuing equity. And this fuels capital investment in operations, which is good. However, a growing concern you see in the sources is when companies borrow money not for productive investment, but for financial engineering. Things like buying back their own shares or paying out big dividends. That can boost the stock price short term, but doesn't necessarily make the company more productive in the long run.
What's the scale we're talking about here? Corporate borrowing in the US?
It's enormous. At the end of Q4 2024, non-financial corporate debt, so excluding banks and finance companies, stood at around $13.74 trillion.
Wow, $13.7 trillion.
Yeah. And to put that in perspective, that's about 36% of the entire US GDP for that quarter. Just corporate bonds issued in 2024 alone was close to $2 trillion.
Nearly half the size of the entire economy, just in corporate debt. What are the consequences when levels get that high?
Well, debt can fuel growth, obviously. But excessive leverage can lead to what's called a debt overhang. That's where a big chunk of corporate profits has to go just to pay interest and principal on the debt, leaving less money for new investment or maybe wage increases. It also dramatically increases default risk, especially if interest rates go up like they have recently. That could potentially destabilize financial markets, impact jobs. You also hear concerns about zombie firms, companies that only survive because they can keep refinancing cheap debt. They don't actually make enough profit to cover their interest payments otherwise. Higher rates could really expose how fragile they are.
Okay, so corporate debt, huge piece, drives activity, but also carries significant risk. How does government debt fit into this picture?
The U.S. national debt, that's the accumulated total of all past government deficits. It gets created when the Treasury borrows money by issuing those T-bills, notes, and bonds we talked about. And they borrow to fund everything defense, infrastructure, Social Security, Medicare, plus responses to crises like the pandemic or the 2008 crash.
And the numbers here are even bigger, aren't they?
Much bigger, yes. As of, say, early March 2025, the total federal government debt was roughly $36.56 trillion. Now that includes debt held by the public, which is owned by individuals, banks, the Fed, foreign entities, etc. It's around $29 trillion. And it also includes intragovernmental holdings, which is basically money the government owes to its own trust funds like Social Security. That's about another $7.4 trillion.
36.5 trillion total. How does that compare to the size of the economy?
Well, the debt held by the public, that $29 trillion part, that alone is around 99% of GDP. The total debt is closer to 124% of GDP. And projections from sources like the Congressional Budget Office, the CBO, they're pretty stark. They show public debt potentially rising to 116% of GDP by 2034, and maybe a staggering 172% by 2054 if current laws stay the same. So it indicates a pretty significant long-term fiscal challenge.
And a big chunk of this debt is held by foreign countries and investors, right?
Yes, foreign investors hold a significant share, roughly 30 to 33% of the debt held by the public. The Federal Reserve holds about 16.5%. And then U.S. domestic investors, individuals, banks, pension funds, hold the rest.
How does this sheer scale of government debt influence the rest of the economy?
Well, high government borrowing means there's a large supply of treasury securities out there that can push up the interest rate, the yield the government needs to pay to attract buyers. And since treasury yields are the benchmark for almost all other borrowing costs, corporate bonds, mortgages, car loans, higher government borrowing costs tend to ripple out and raise borrowing costs for businesses and households too.
This is the crowding out effect I've heard about.
That's part of it, yes. The idea is that government borrowing competes for available savings or investment funds, making capital more expensive for the private sector. That could potentially dampen private investment, which in turn might slow down productivity growth and maybe even wage increases over the long term. Some sources estimate that each extra dollar deficit might crowd out about 33 cents of private investment. Plus, the growing amount the government has to spend just on interest payments on the national debt. That consumes a larger and larger share of the federal budget, potentially crowding out spending on other priorities like education or infrastructure, or eventually requiring higher taxes.
And having such high national debt can also limit the government's options if another crisis hits.
It reduces their fiscal space, their ability to deploy large stimulus packages or respond quickly to unexpected events. There's also a risk, although it's debated how big it is, that markets might start to worry the central bank could be pressured into monetizing the debt, basically printing money to buy government bonds directly, which could potentially fuel inflation down the road.
Government debt is massive and influential. What about the third piece? Personal debt, the debt individuals and households hold.
This is the debt people take on for consumption or for personal investments. We're talking mortgages to buy homes, student loans for education, auto loans for cars, credit card debt, home equity lines of credit. It's distinct from business or government borrowing, but it's equally massive in scale.
And what's the total scale of household debt in the U.S.?
Total household debt hit a record high of $18.20 trillion in the first quarter of 2025. The biggest single chunk by far is mortgages, around $12.8 trillion. But student loans at $1.63 trillion, auto loans at $1.64 trillion, and credit card debt at $1.18 trillion are also immense burdens for many households.
How does that $18 trillion relate to people's incomes? Does it tell us if households are generally stretched too thin?
Well, one way economists look at that is the household debt service ratio, or DSR. That measures total required debt payments, principal, and interest as a percentage of disposable personal income. In the last quarter of 2024, it was around 11.28%. Now, while the total dollar amount of debt is at a record high, that ratio is actually still below its peak reached just before the 2008 financial crisis. So that suggests that in aggregate, maybe households aren't relatively as burdened by debt payments compared to their income as they were back then. However, and this is important, that aggregate number can hide real stress points. We are seeing delinquency rates rising, particularly on credit cards and auto loans, which indicates significant strain for many individual borrowers, especially perhaps lower income households. What role does all this personal debt play in the broader economy? Oh, it's a massive engine of economic activity. Personal consumption makes up over 2/3 of U.S. GDP, and debt fuels a significant portion of that spending. Mortgages enable home ownership, which has knock-on effects for construction, furniture, etc. Student loans finance education, building human capital. Auto loans facilitate purchases of cars and other durable goods. It basically allows people to consume and invest earlier in their lives than their savings loan would permit, sort of smoothing their spending over their lifetime.
But some of the sources also highlighted concerns about people increasingly relying on high-interest debt, like credit cards, just to cover basic necessities.
That's a critical point, yes. When wages don't keep pace with the rising cost of living for many people, Households might turn to credit cards, not for big discretionary purchases, but just to cover everyday expenses, groceries, gas, utilities. This kind of necessity debt doesn't typically generate future income or build an asset that helps repay the debt, so it can lead to a cycle of accumulating high interest, persistent indebtedness, and very limited financial flexibility. And that ultimately acts as a drag on future economic growth because those households have less money available for other spending.
So, just like corporate and government debt, personal debt is a powerful tool for growth, but it's also a source of significant vulnerability, both for individuals and the wider economy.
And the crucial thing to really grasp now is that these three massive pools of debt, corporate, government, households, they don't exist in separate silos. They are deeply and sometimes dangerously interconnected through our financial system.
How do they influence each other? What are the main connections?
Well, the interest rate channel is probably the most direct one. As we mentioned, Treasury yields the interest rate the government pays act as the benchmark for almost everything else. So, changes in what the government pays to borrow directly impact corporate bond yields, mortgage rates, car loan rates, credit card rates, the cost of private borrowing, and the Federal Reserve's monetary policy actions like setting the federal funds rate target or doing QE, buying bonds, or QT, quantitative tightening, letting bonds mature or selling them. Those actions directly influence Treasury rates first. And through that, the cost and availability of credit for businesses and households across the board.
Right. So, if heavy government borrowing pushes up treasury yields, it just gets more expensive for everyone else to borrow money too.
That's the classic crowding out mechanism. And conversely, when the Fed did massive QE, buying trillions in bonds, the specific goal was to lower those benchmark rates and inject liquidity into the system, precisely to make it cheaper for everyone to borrow, hoping to stimulate both corporate investment and household spending, which of course fuels growth in both corporate and household debt. And now, as the Fed unwinds that through QT, the risk is it pushes rates higher and tightens credit conditions for everyone.
And financial institutions, banks, but also non-banks, they seem like the glue holding all this together, connecting these different types of debt.
They are the conduits. They buy government debt. They lend directly to corporations. They provide mortgages and consumer loans. And they often package these loans, mortgages, corporate loans, auto loans, into securities that are then sold to other investors. So the health of these financial institutions, their profitability, their willingness to lend, that's all influenced by their own funding costs, which are tied to benchmark rates and Fed policy and their capital levels. And that determines how easily credit flows between these different sectors.
And by packaging debt like mortgages into mortgage-backed securities or those leveraged loans into CLOs, they create even more complex links between different markets.
Yes, the securitization in theory distributes risk, but it also creates very complex interdependencies and sometimes a lack of transparency. It means if one part of the debt market comes under stress, say a wave of corporate defaults in those leveraged loans or a downturn in the housing market affecting mortgages, that stress can spread very quickly through the financial institutions holding that debt or holding securities backed by that debt. And the growth of what are called non-bank financial institutions, or NBFIs, things like investment funds, hedge funds, private credit firms, they play a huge role now, but often operate with less regulation than traditional banks in some areas. That adds another layer of complexity and potential channels for risk to spread.
What are some other ways these different debt sectors are linked?
Well, there's a fundamental economic feedback loop. Think about it. Household consumption, which is often fueled by personal debt, is what drives corporate revenues. And corporate health, which might be enabled by corporate debt allowing investment and hiring, affects jobs and wages. That, in turn, impacts household income and their ability to service their existing debt or take on new debt. So a significant downturn in one sector's ability to manage its debt can easily ripple through and affect the others.
And large investors probably hold portfolios that mix all these different types of debt assets.
Yes, that connects everything too. If big bond investors face losses in one market, maybe in risky corporate debt, they might be forced to sell assets in other, maybe safer markets like treasuries, either to cover those losses or meet withdrawal requests from their own investors. This kind of asset network effect means distress can propagate across different types of debt and different markets quite rapidly.
So the sheer scale of debt across all sectors, combined with all these linkages through interest rates, financial institutions, and investors, it creates pretty significant systemic risks, doesn't it?
It definitely increases the fragility of the entire system. It means a shock in one area, maybe a sudden jump in interest rates or a wave of corporate bankruptcies, or a housing market correction can cascade through the system more easily. The immense amount of debt outstanding means there's just less cushion, less room to absorb losses before problems start to spread.
And the recent shift from that long period of ultra low interest rates to much higher rates now must be making these risks even more acute.
Significantly so, yes. Higher rates directly increase the cost of servicing debt for everyone. Corporations needing to refinance old cheap debt face much higher costs now. The government has to pay more interest when it issues new treasury bonds, which is becoming a rapidly growing line item in the federal budget. And households with variable rate debt, like some mortgages or credit cards, feel the pinch immediately. And anyone taking out a new loan for a car, a house faces much higher payments. All of this squeezes corporate profits, increases the government's interest burden, and strains household budgets, potentially leading to higher defaults across the board.
And higher rates also push down the value of assets that were bid up when debt was cheap.
Higher interest rates put downward pressure on asset prices that benefited from the low-rate era, everything from real estate to the bonds themselves that were issued at lower rates. This reduces collateral values for loans, reduces household net worth, potentially forcing asset sales and amplifying downward spirals in markets.
Wow, it really sounds like a highly complex and potentially quite vulnerable web we've woven.
It is. Financial institutions, as we said, act as key transmission belts for any contagion. If they take losses on one type of debt, it impairs their balance sheets, reducing their capacity or willingness to lend to other sectors. Market liquidity can suddenly dry up. Credit cycles can become self-reinforcing. Rising defaults lead banks to tighten lending standards, which slows the economy further, which can lead to even more defaults. And because the US dollar plays such a central role globally, US debt dynamics have massive international spillovers. And conversely, financial stress originating elsewhere in the world can feed back into the US system too.
So, what does all this mean for the long term health and sustainability of the economy?
Well, high and particularly rising government debt is projected by many, like the CBO, to dampen long-term economic growth, primarily through that crowding out effect on private investment we discussed, and also by diverting more and more national income towards making interest payments, an increasing portion of which actually goes to foreign holders of U.S. debt. The CBO's long-term projections really highlight this challenge quite starkly.
And the sustainability of it all really hinges on that relationship between the interest rate the government pays on its debt, R, and the rate of economic growth, G, that R versus G dynamic.
Crucially important, yes. If R, the average interest rate the government pays on its debt, is consistently higher than G, the rate of nominal economic growth, then the debt to GDP ratio will tend to rise automatically over time, unless the government runs large primary surpluses, meaning tax revenue exceeds non-interest spending. If economic growth slows down or if interest rates stay elevated, managing the debt burden becomes significantly harder.
And this could potentially lead to that sort of doom loop scenario that people sometimes talk about.
It's a potential risk. The idea is that high government debt could push up interest rates, which increases the government's interest costs, leading to even larger deficits, requiring even more borrowing, which could push rates even higher, slowing economic growth further, worsening that Army's G gap, and so on. And if banks holding large amounts of this government debt start facing losses as rates rise, they might pull back on lending to the rest of the economy, further slowing things down. It becomes a negative feedback loop.
And it's not just government debt, right? Corporate debt that was used unproductively or very high household debt loads, those can also act as a drag on future growth by reducing funds available for productive investment or crimping future consumption.
It's right. The system really functions best when debt is channeled towards genuinely productive investments that generate the income to repay the debt, or towards consumption that can be comfortably serviced out of income. The current reality is this vast, interconnected web of debt that underpins our entire money supply, with significant potential implications if any major part of that web snaps under pressure.
Wow. We have covered a remarkable amount of ground today. We went from the fascinating historical roots of the credit theory of money all the way through the actual mechanics of how commercial banks literally create new deposits when they make loans, and then traced how government deficit spending and all that personal borrowing fit into this whole debt money landscape.
Yes, and I think the fundamental takeaway, if there's one thing, is that modern money, really in all its forms, is just intrinsically linked to debt. Whether it's the deposit number you see in your bank account that's the bank's liability, it's debt to you, or a treasury bond that's the government's promise, it's debt, or your own mortgage, that's your obligation, your debt to the bank. It all originates as some form of debt. And this system, which got really amplified in the fiat era and formalized through central banking, it's the engine of our economy, definitely. But it inherently comes with these vulnerabilities we've discussed.
We mapped out the truly immense scale of debt across the corporate, government, and household sectors here in the US, trillions upon trillions of dollars, just massive relative to our GDP. And maybe even more importantly, we saw how these are all deeply interconnected through the financial system, through interest rates acting as the glue, through investor behavior linking markets.
Treasury yields, as we said, act like a gravitational pull on all private borrowing costs. Financial institutions are the essential channels, moving capital around, transforming risk sometimes in complex ways. And the health, or lack thereof, of one sector's balance sheet can trigger reactions across the entire system, especially in times like now, with shifting interest rates. You get these feedback loops, these channels for contagion.
Pulling all this together, what does this fundamental reality really mean for you listening to this? Understanding that money is born from debt, it isn't just some, academic trivia point. It helps demystify the financial system you interact with every single day. It clarifies why things like interest rates matter so much, why it matters whether banks are willing to lend, why the size of government deficits is constantly debated, why the financial health of big corporations and households are all fundamentally intertwined. It really impacts everything. From your ability to get a car loan or a mortgage to the stability of your job, even to the long-term burden of the national debt that you as a taxpayer are ultimately connected to.
And it reveals that the value of the dollars you use isn't really anchored in a physical commodity like gold anymore. It's based on this complex, constantly shifting network of social obligations, legal frameworks, and ultimately trust. Trust in the issuers, both the government and the banks. The big debates we touched on, MMT arguing the government's unique power, Austrians wanting sound money free from credit expansion, monetary reformers looking for a different system entirely, they all stem directly from different interpretations of this debt-based reality. Is it a feature we need to manage, or is it a fundamental flaw that needs to be fixed?
It seems pretty undeniable, though, that debt isn't just some side effect of our economy. It's literally woven into the very fabric of how money is created and how it circulates in the world today.
Which leaves us, perhaps, with a significant question for you to ponder. If the engine of our money supply is credit expansion, and money generally gets destroyed when debt is repaid, does that imply that our economy must continuously take on more debt across all sectors, government, corporate, household, just to maintain or grow the amount of money in existence? What are the fundamental long-term implications of a system that seems to require perpetual debt creation to keep functioning?
It's definitely something to consider the next time you swipe a card or see that balance in your bank account.
When you pull back far enough, the numbers all blur. Trillions in household debt, corporate bonds, government deficits. But one principle remains sharp. Money only exists because someone agreed to owe. What happens when that debt grows too large, too interwoven, and too fragile to unwind without breaking something?
Please like and subscribe.